My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and I'd like to welcome all of you to our May webinar featuring Mark Hulbert. You can all see on the screen the two presentations that Mark will be giving today. I'd like to give a little introduction. I subscribed to Mark Hulbert's Hulbert Financial Digest for many years and quite enjoyed it. It was, for me, one of the investor educational publications that I read and found useful. And what he did was he objectively ranked investment newsletters performance, or the performance of the investment advice that they gave, and then published that in lists and rankings, and then also added his own commentary, which I found very useful because often it talked about background issues in the market that people might not be thinking about. And the interesting thing about newsletters was that they were, many of them, quite self-promotional, and they would claim performance that was often cherry-picked. But Mark would track the performance of just exactly the way the newsletter described it. In other words, if the newsletter said buy something, Mark recorded that as a buy or sell. So it was the actual performance that an individual could have achieved by following the directions. And interestingly enough, sometimes the ads from various newsletters heavily inflated the performance. And Mark would point that out. and those newsletters that performed very, very well, that was confirmed through the newsletter. And again, what I really appreciated about Mark's commentary was that he tried to, and I think succeeded in, talking about what really mattered in investing. And recently, I run an investor discussion group, which was one of our special interest groups where we get together, and we used to do it in a restaurant. And Al Zmilowski, one of our board members who loved interesting topics, used to bring copies of Mark's MarketWatch commentary and hand them out at the meeting, and we discuss it. So the kind of the tradition of bringing up interesting issues and talking about what matters was carried on. Anyway, a couple of quick comments about the form of the meeting. Please type in your questions in the chat in the middle of the screen, and then we'll feed those questions to Mark, and we'll do it as appropriate during the meeting and during his presentation, and then at the end we'll add the other questions where we have time. So let's give a warm welcome to Mark. You have the podium.
Well, thank you, Lynn. First, I need to check, make sure everyone can hear me, I hope, right? Can everyone hear me?
Yes.
Okay,
yes.
Good. So, so thank you very much for that introduction, Lynn. In fact, you were, before the beginning of the meeting, we were talking about, I think it was 4 years ago that I was last at the, visited your chapter in person. I'm sorry I can't be there today. I would in fact love to be there, but the miracles of technology make this almost as good, or in fact sometimes even better. So anyway, and Lynn, you've actually gone through a couple of my first initial slides that I'm going to go through by way of introduction. You've done a good job of indicating where I've been coming from. I'll just add a few more details about that and then get right into to what I want to talk about today. You'll see there on the screen that I'm giving 2 sessions today. The first will go up till about 10:20. Then we'll have a 10-minute break, and then the next session starts at 10:30 and it'll end at around 11:30. Believe it or not, the 2 sessions, even though they look like they're on entirely different topics, are related. In fact, it's because of the lessons that I draw in looking at advisor and mutual fund rankings that I believe contrarian analysis has something to offer. And so one does lead into the other. And so I hope you can stay for both, but each will stand on its own if you can only look at one or attend and listen to one or the other. So as Lynn mentioned, I've been tracking investment newsletters for the last 40 years. In fact, I started on June 30th of 1980. I like to remember that the Dow Jones Industrial Average on the first day that I started tracking model portfolios was 788. And if the market moved up or down, 10 points, that was considered front page news. It's amazing how the world has changed over the last 40 some years that I've been doing this. What I do is basically objectively track the performance of investment newsletters, as Lynn mentioned. I do this by constructing model portfolios according to the advice provided by those advisors. I execute the trades at the prices that anonymous subscribers would be able to act on the advice. That's crucial, because we would find that sometimes newsletters that we were tracking would send us their issues of their newsletter in advance of when they would send it out to the rest of the subscribers. And that, of course, gave them the benefit of any price bump that would come from a lot of people buying it, or on the same side on the same way on the sell side. So we wanted to be to reduce any vulnerability to that. So we would carefully timestamp or any advice that we got, and we would only use the price that prevailed in the session after that advice was received. And we took commissions into account, dividend splits, and all corporate actions and so forth. So it was as realistic a simulation as I can imagine setting up to track the real world performance of these newsletters. I mentioned the word simulation. That's probably important to emphasize. We weren't actually trading real money. So there's always the possibility that there's slippage between what we showed was possible in a simulation, realistic as it might be, and the real world. Though a lot of the newsletters had actual model portfolios themselves, and some of them would even say that they would be willing to share their brokerage statements if you had any doubt about their performance. And at least in those cases, what we were reporting was down to a basis point or two different from what they were reporting. So I'm pretty confident that the numbers that we came up with are definitely reflective of the real world. So I want to say a few things about what's happened to the Hulbert Financial Digest. I sold my newsletter, the Hulbert Financial Digest, to CBS MarketWatch in 2002, and they in turn were bought by Dow Jones in 2005. I came along for the ride when they bought CBS MarketWatch, and then Dow Jones, which, no criticism of them, but they didn't really want to be in the newsletter tracking business. They shut down my newsletter in 2016. Since then, I have continued to monitor newsletters, but under a completely different business model. Up until 2016, I would subscribe to all the newsletters and pay the staff myself, my staff myself. And the way we would make money is by selling subscriptions to the Hulbert Financial Digest. After Dow Jones shut down my newsletter in 2016, I was unable to find a publisher who was willing to continue under that model. So what we've done is we've actually hung out our shingle as basically a performance auditing firm. Newsletters will come to us and say, I want you to track our performance using the same methodology that you did when the Hulbert Financial Digest was being published. And they pay us a flat fee to have us audit their returns. I mentioned that flat fee because even though it's not ideal that we're in a business where they actually pay us to rate them, we charge a flat fee, so there's no particular incentive on our part to make one newsletter look better than another. And so I want to be fully transparent on that's how we go about continuing to track investment newsletters. One interesting thing that we didn't really think about when we went to this new business model is that most newsletters, as you know from reading what I've written over the years, most newsletters, as well as most mutual funds, underperform the market and have no desire, therefore, to pay me to continue to track them and report that they've underperformed the market. So the only newsletters that were interested and are continuing to track them were the small subset of newsletters that had good long-term records. And so it's really not a very robust business model that we chose. But one of the things, and this gets into where I'm going to be talking about some of the lessons I've drawn from all of this experience, it does provide a nice real world experience of whether the best performing newsletters are able to repeat their good performance. Because the only newsletters that have continued to have us track them, as I mentioned, are those that have had good long-term records. I then publish the track records that we calculate for those newsletters that continue to have us track them, and they're available free of charge to the public at that website that you see there. So I don't have a newsletter anymore, but you don't need to pay for my newsletter anymore because you can now access the ratings on that website. So this is what the website might look like. This is the one, the current one for the 12 months. I have scoreboards from as short as 12 months to as long as 40 years. And so you can see which newsletters have done well over whatever period of time that you might choose. So that's by way of background. So now I want to get into it. There are 6 investment lessons that I think are important that can be drawn from my 40 plus years of tracking investment newsletters. I track the mutual fund industry as well, just privately for the point of view of supporting some of the columns I write for MarketWatch. And I can tell you that the lessons I would draw from tracking in mutual funds are identical to tracking investment newsletters. So these, I think, are relatively timeless and general lessons that can be drawn from long-term investment performance. And as I mentioned earlier, that we have a nice real-world experiment with my current business model of whether the best performers in the past have continued to be good performers in the future. And that's why I have the title of this particular slide, Return Persistence is the Key. And the reason for that is the following. We all know that very few active managers beat the market. That's true of investment newsletters. It's true of mutual funds. We all know this. It's in one sense a boring insight, right? We all know it. And yet we still try to believe that we can beat the market. And the reason we do is that we don't really care. If it's only 5% of the world is able to beat the market, if those 5% are able to repeat as good performers and market beaters in the subsequent period, we don't care that there's also another 95% of the world that is unable to beat the market. So the real key here is if we can find that the select few who've beaten the market in the past are able to repeat their performance, we don't really care that it's a small percentage. And so that's the reason I want to key in on return persistence, because I think that's the real $64,000 question when you look at mutual fund rankings, hedge fund rankings, newsletter rankings, you name it. So here I have a chart that I want to report what I found. So before I actually chart any of the data here on this particular chart, I want to tell you what I did. Basically, I took all newsletters calendar year performances. So in other words, for every newsletter, for every year, I would report or calculate what the percentile ranking of it was relative to all other monitored newsletters. So the best performing newsletter would be at the 100th percentile, and the bottom one would be at the 0th percentile. And then for each one of those annual rankings, I then looked at what its percentile ranking was in the subsequent year. So basically, for all newsletters, I created pairs. The first of every pair is its percentile ranking in year 1, and the second half of the pair is its percentile ranking in year 2. And I did this for all newsletters that I've been tracking back to 1980. I believe that the total number of pairs in this particular study I did was 15,800 and some. So basically, we had lots and lots of pairs of percentile rankings. One of the first half of the pair, as I mentioned, is in the first year, and the second percentile ranking is its subsequent year performance. And so what this particular chart shows is on the bottom horizontal ranking, on the horizontal axis, I show the decile of where a newsletter was on average in year 1. And then I look at what its average percentile rank, or average decile of its percentile ranking was in year 2. So the charts, the columns that I show there is that if the world was one in which it was performance was all skill and no luck, this is how the chart would look. And the reason is that if you look at the very first column there over on the left hand, near the left hand side of the graph, you'll notice that the top decile were ranked in the 90th to the 100th percentile in year 1. On average, they were at 95, right? That was their average percentile ranking in year 1. If that was a matter of pure skill, you'd expect the average of their percentile ranking in year 2 would also be 95. And you see this, it would just be monotonically declining like that. So the second decile for year 1 performance would have an average percentile ranking of 85, and it would be 85 in year 2. So that's what this graph would look like if it was if performance were a matter of pure skill. The green bars would show what it would look like if it was a matter of pure luck. So basically, your average percentile ranking in the second year would always be right at the middle. That's your expected ranking would be in the middle of the distribution in year 2, regardless of where your ranking was in year 1. And the reason for that is that it's all a matter of skill. That's hypothetically. So for example, if we were all flipping coins and we then put ourselves in deciles for how many heads we were able to flip out of 100 coins in year 1, and then looked at what our average percentile ranking was in year 2, it would look exactly like what these green bars look like. So now what I'm going to show you is what it actually looks like in practice. So this is, again, on average across all 15,000 and some pairs that I have of newsletter returns back to 1980. And you'll notice that these red columns are remarkably close to the green columns, which are the ones that it represent as if it were a matter of total luck. Not exactly, but remarkably close. So for example, if we look at the very left-hand set of columns reflecting the 10% that were in the top decile for year 1, their average ranking, their average percentile ranking in year 2 was 53%. So that difference between 50 and 53 is not statistically significant. Even if it were statistically significant, what you'd conclude is that by going with the top ranked newsletters in year 1, you have an ever so slightly increased chance of being an above average performer in year 2, but it's ever so slight. But it turns out to be not statistically significant. The only thing that's interesting here is how over on the very right, in the 9th and 10th deciles for performance in year 1, you find that their average ranking in year 2 is actually a little bit below average. And in fact, this last ranking, the last reflecting the 10th decile, is statistically significant, which is to say that if you were to invest with the worst newsletters in year 1, you have a statistically robust expectation that you'll be a below average performer in year 2. And what's interesting about that is that the only thing that's statistically significant about these results are that people who are at the very bottom of the ranking are probably ones you should avoid. But when you get to the top of the ranking, which is what we always tend to focus on, we always want to focus on who's the best performer. By doing so, you don't increase your chances of beating the market by a statistically significant amount. So what this might suggest, I mean, if we were to try to draw a lesson from all this, is that the best thing that I probably have done, but the greatest social benefit that I've created for my clients over the last 4 decades, is that you should avoid the worst performers. That's just the opposite of what people tend to focus on, as I mentioned, but that is probably the best thing you can do looking at performance rankings. And this is true in the mutual fund ranking and so forth as well. So somebody who's a terrible performer, it's probably a good idea to give them a pass. But other than that, performance shows remarkably little persistence. So I have a couple other charts that make the same point, and I'll go over them relatively quickly. So what I did here is I broke it down to quartiles rather than deciles. So then I'm just looking at the top 25% and the bottom 25% of advisors in a given calendar year. And then I want to see the average percentile ranking of them in the subsequent year. I drew this blue horizontal line there to indicate that if things were a matter of pure randomness, you'd expect that the top quartile and bottom quartile of advisors in year 1 would be at the average ranking for them, percentile ranking in year 2 would be exactly at 25%. Well, here's what we found. So among the green vertical bars reflect the top quartile advisors in a given year. Notice that the top quartile of advisors in year 1, only 20% of them are in the top quartile in year 2. Whereas the advisors who are in the bottom quartile in year 1, oh, excuse me, the ones who are in the top quartile in year 1, you have about 18% of them in the bottom quartile in year 2. So the difference between that 20% and 18% is nothing to write home about. But what's even more interesting is if you look at the advisors who are in the bottom quartile in year one, you have a greater chance of them being in the top quartile in year two, though you also have an above average chance that they'll be in the bottom quartile in year two. Again, it just puts it a different little texture on it, but it shows that by going with the top quartile of advisors, you haven't necessarily increased your chances of success. I did the same thing at the 3-year horizon. So now instead of looking at 1 year subsequent paired with a subsequent year, I look at a 3-year past performance and then see if it is persisting into this subsequent 3 years. And it, again, so now you look at it, so the green bars are those who are in the top quartile of advisors in an initial 3-year period. In the subsequent 3-year period, now we're only down only 15% of them are in the top quartile in the subsequent 3-year period. And an above average amount of those top quartile of advisors are in the bottom quartile in the second 3-year period. So this suggests that there's a lot of regression to the mean. So basically the top go to the bottom and the bottom go to the top. And that's especially revealed by the orange bars, where actually now you see an above average chance that the bottom quartile of advisors over 1 3-year period are going to be the top quartile in the subsequent 3-year period. This is exactly the opposite of what we assume when we start going through the performance rankings. Now I've done the same thing at the 10-year horizon. And it's also depressing. Notice that here are the green bars are those who are in the top quartile of advisors for performance in a given 10-year period. And it turns out that only about 18% of them are in the top quartile in the second 10-year period. So that's below what you'd expect on the basis of randomness. And it's even worse for the bottom quartile of advisors. So this data, again, there's a number of different ways of slicing and dicing the data, did not give us a lot of hope that by going with the top performing advisors, we're going to have any, at least statistical confidence, I guess the way I put it, that we're going to beat the market in the subsequent period. So what's going on? Clearly, randomness and luck play a huge role. And again, I think this is something we probably always appreciate and have known many times in the past. It's worth emphasizing because I think what happens is that we all sort of pay lip service to the fact that we know randomness and luck are playing a big role, but then we turn around and act as though that randomness and luck do not apply to us. And I'm here to tell you it applies to all of us. But the interesting other lesson I draw from this is that there's something more besides going on, since the results are even worse than would be expected on the assumption of pure randomness. So as I say, with those three previous charts, you notice I had the horizontal line indicating what you'd expect on the basis of pure randomness, and the results were even worse than that. So it's not like it's just everyone's average performance in the next year. The top performers on average are below average performer in the subsequent period. So I call this negative skill. We're going to talk a lot about this morning, but the key point is that luck alone cannot explain all the results that we have. And again, it's the same thing in the mutual fund arena as well. Luck cannot explain these poor results. And there's this additional factor, and we're going to talk about it. For the moment, let's call it negative skill. It's basically, there is skill, but it's basically skill that detracts from performance rather than adds to it. So the question is why? So here is a chart that is made, it's from a study 20 years ago, but it's classic, and it's been, I think, confirmed many times since then, but it's particularly stark results, so I continue to report it. So basically, a professor at Berkeley, Terence O'Dean, got the trading histories of 64,000 accounts at of individual investor accounts at a discount brokerage firm. And he looked at all the trades of those accounts. And what he did is he basically constructed pairs of trades. The first half of every pair would be when an investor sold a stock. And the second half of the pair would be a subsequent purchase if that purchase occurred within 30 days of the sale. And the assumption behind that construction was that if you sell a stock and then buy another one in 30 days, chances are that you are thinking of the one you purchase as a replacement for the stock you sold. Otherwise, why would you have sold the one and bought the other? Now, I'm sure there are many other scenarios and narratives we could tell, but on the whole, I think that's a fairly safe assumption. So what then Professor Odin did was look at the performance of the stocks that were added relative to the stocks that were sold. And he did not include commissions or taxes. So this is just raw, unadjusted performance. So it turns out 4 months later, after those pairs were constructed, the stocks that were bought were 1.5% lower than the stocks that were sold. So basically, for the transactions that these investors undertook on average, they were 1.5% worse off for undertaking those transactions relative to having done nothing. A year later, it was even worse. They were over 3% down relative to the null set of doing nothing. So isn't that amazing? So basically, every time on average that we buy or sell a stock, every time we sell a stock and replace it with another one, if we're on average no better or worse than other investors, we are going to be 3 percentage points more, 3 percentage points worse off a year later relative to where we would have had we not even undertaken that transaction. And at 2 years, it's even slightly worse. And again, this is an indication of what I call negative skill, purely negative skill. You cannot account for this result on the grounds of pure randomness. If we only randomly sold and bought stocks, in other words, we were just flipping coins and everything was 50-50 probability of going up or down, we'd find that there is no difference between the stocks that were sold and the stocks that were bought. The fact that systematically the stocks that are bought are worse off than the stocks that are sold is something that cannot be accounted for by randomness, and that's what I call a negative skill. I want to give another illustration, and again, this is just a different way of slicing and dicing my data to show that the average thing we do is worse than you can explain on the grounds of pure randomness. So consider what would happen if in a given year we froze our portfolios into place on New Year's Day and did nothing for the rest of the year. And if our trading added value, then our actual portfolio should have done better than our frozen one, right? So it's a fairly simple test. So basically we're benchmarking every portfolio to a frozen portfolio that equals what it was on the beginning of on New Year's Day and doing nothing to that portfolio through the end of the year. So anyway, the chart here shows the degree to which frozen portfolios beat actual portfolios. And I guess this is an average across newsletters. So basically, on average, and I've done this study a number of years, going back to 1980, the frozen portfolios were about 73 basis points better off at the end of the year than if they had undertaken no transactions. And interestingly enough, there's a study done in the mutual fund industry using the identical methodology. I give the citation there at the bottom. And they found something remarkably similar, they're slightly larger, about 78 basis points. Okay, so the second lesson then I draw is that it's basically our emotions are what make matters worse. So basically you have luck, which makes things bad enough, and then our emotions make matters even worse. So now I want to get into some other lessons I've drawn. We're going to come back to all of these lessons later, but I just want to get all of this out on the table.
Do you mind if I throw a question in, Mark?
Go right ahead, Lynn.
We had a question. How often do managers persist following same strategy across each performance period?
We have not found, that's a great question. We have not found that there is any correlation between the degree of persistence. Well, I shouldn't say that. There is some correlation that if a manager is consistent in following a strategy, he will have a greater chance of persisting into the future than if somebody is just jumping around, trying to chase yesterday's returns. And so there is some of that we're always chasing yesterday's return, and that accounts for some of it. Depressingly, though, even among advisors that have consistently followed the same strategy, so they're not jumping around from strategy to strategy, even their results are less, are inferior to what you'd expect on the basis of pure randomness. So, we're going to get to this later. Consistency and discipline, and those are both great virtues to have in the investment arena. So I don't want to deny that those are good virtues, but I don't think that they, in and of themselves, can turn these results that I'm reporting around. Okay, so I want to get to this general subject of when we try to extrapolate the past into the future, and that's related to this issue of persistence, because that's what we're doing. We're trying to extrapolate the past into the future. We think the best performers in the past will be the best performers in the future, and so forth. But it turns out that we make a mistake, almost all of us do. When we project the past into the future, we project that strategy's average return, but we do not project its volatility into the future. And that's a problem for any of a number of reasons, which I'll discuss. But one of the things that's interesting about that is that researchers have found that a portfolio's volatility is a far more, has greater persistence than the performance. So in other words, let's say that I have a portfolio that's 20% more volatile than the S&P 500 over the last 5 years. Let's just make up a hypothetical. Chances are that my portfolio's volatility relative to the S&P 500 for the next 5 years will be very close to 20% more. You cannot say the same thing about performance. So it's interesting that we choose not to extrapolate volatility into the future, because that's one of the areas where there is a more of a statistical basis for that extrapolation. So the conclusion that you draw from noticing that volatility stays the same is that if the future is like the past, the strategy could still produce a dramatically different result for no reason other than volatility. And this is a conclusion that Fama and French, the famous researchers in the academic arena, have in a Financial Analyst Journal article, and I have a citation there. I recommend that article highly, but I'm going to go through a couple of the tests that they applied to show this. So basically, they then used the conclusion that you can have the world be just like, the future could be just like the past, and yet volatility can sabotage the returns. So what Fama and French did is they assumed that each month into the future, the equity premium would be equal to what it was in a randomly picked month from the last 50 years. So they basically put, imagine this, they put into a big hopper 50 years worth of monthly returns. And the equity premium, of course, is the amount by which the stock market outperformed the bond market. So you have basically 600 monthly returns in this hopper. So you mix up everything in that hopper and you randomly pick one out and say, okay, that's what my equity premium will be in month number 1 going forward. And then you put it back in the hopper and mix it all up again and do it again for month number 2. So you do this, and then they run 100,000 simulations, basically a Monte Carlo simulation, and you calculate the proportion of times in which strategies that outperformed the market in the past, they look to see the proportion of them that did not outperform the market in the future. And notice that this is because of volatility alone that would sabotage these results. So this looks over a 1, 3, 5, 10, 20, and 30-year horizons. The first set of bars are the equity premium. So over a 1-year horizon, there are 100,000 simulations found that in 37% of them, the equity premium will be negative, which is to say there is basically a better than 1 out of 3 chance over the next 12 months that bonds will outperform stocks, even if the future is like the past. It goes down, but even at the 30-year horizon, notice that there's close to a 10% probability that bonds will outperform stocks, again, for no other reason than projecting volatility into the future. And that is something that is a depressing thing, because we always assume that if we hold on long enough, stocks will win out. And what they're showing is that that is not necessarily the case. The next set of bars are for the value premium, which is the amount by which value stocks outperform growth stocks. We all know that over the last decade, value has not done well. Growth has far outperformed value, in contrast to what the long-term historical data would suggest. And it's a similar conclusion. Let's look at the 10-year bar. Notice that it's above a 10% chance at the 10-year horizon that value will underperform growth, even if the future is like the past. And I want to emphasize that even comment, because a lot of people are trying to explain that value is done poorly because accounting rules have changed. The idea that basically intangible assets, which aren't part of book value, in most cases are not included in the calculation of the price to book ratio, and that intangible assets play a bigger role now than they have in the past. There are a number of explanations, all of which have definite plausibility in their own right. But notice that you don't have to go to any of those possibilities to explain why value has underperformed over the last 10 years. You could say it's just a matter of bad luck. And there's a greater than 10% chance that that is indeed the explanation. So Occam's razor might suggest that we don't need to look to any other hypotheses and just say, because of volatility or luck alone, you could see that this is a distinct possibility. Lastly, I have the small cap premium, which is the amount by which small cap stocks outperform large cap stocks. And notice that there's an even bigger probability here. Even at 30-year horizon, there's a 15% chance that the small caps will not have outperformed the large caps. So this is, again, a great illustration of the role to which luck can play a big role in performance. We, being human beings, we love to try to come up with explanations for something because we find it hard to accept that luck could play such a big role in something that is important to us as our retirement financial security. And yet, that doesn't, just because we find it hard to accept doesn't mean it's not true.
Mark, before we move on to the next topic, sure. Can you take a question?
Of course.
This is from Dan. There are groups in almost any investment house that perform sophisticated analysis of mutual fund performance, including physical due diligence, using more complex statistics such as information ratio, Sharpe, Trainer, Sortino. They claim to have more success in picking funds. What's your view on the process and their claims?
Of course, I can't say that I've studied every one of these sophisticated teams in a lot of investment houses, so I can't respond to any one case in particular. I can tell you that my prior belief, before I've done any research, is that in most cases their performance will be no better than what I'm reporting here. I mean, it's interesting. I've given talks like this now for 40 years, mainly to AAII chapters, and I can't tell you the number of people who will come up to me after my talk with computer printouts and analyses and all kinds of sophisticated econometric, tests and regressions that they've run, and say this is, as overwhelming proof that it's going to beat the market and so forth. And they ask me what my attitude is, and my response in every case is that it will not beat the market. And I know I'll be wrong about 10 to 15% of the time, which is the percentage of time that advisors are able to beat the market. But I'll be right 85% of the time, and I'm willing to take those odds any day. And I think those odds apply to the most sophisticated of investors. Look at hedge funds. I've done the same analysis here for hedge funds, and there's no greater performance on average among hedge funds than there are among regular open-end mutual funds or investment newsletters. In fact, one major study by a finance professor at Duke looked at hedge funds in general, and he had a sophisticated analysis to try to see how many of them even earn their hefty management fees. And he found that I think it was 1% or even less than 1%. I mean, it was basically almost next to zero. So even though there are a lot of smart people out there, and I'm not going so far as to say it's impossible to beat the market. So I want to make sure I'm clear in saying that it is possible, and there are people who do, but they are in a distinct minority. And unfortunately, even among those who do beat the market, relatively few of them are able to beat the market in the subsequent period. So even though it's possible to beat the market, and there are some people who do beat the market, it's an acceptable and rational conclusion based on the data that I'm presenting here. And of course, lots of other people have similar data being presented. The rational conclusion is to act as though you can't beat the market. So it's an interesting nuance there. I'm not saying it's impossible to beat the market. I think there are very smart people out there. People like Jim Simon's Renaissance, Renaissance Technologies, his Medallion Fund has produced a 39% annualized return since the 1980s. Statisticians who've looked at it said that that's way beyond what you could attribute to mere luck. And so so you know, there are people like that, but chances are that you know, for every one of the Jim Simons of the world, you're going to find 1,000 people who don't know who don't have the ability to beat the market. And so the question is, how do you want to play those odds?
Mark, I guess another quick question is, am I the only one wondering whether luck would predict that 10, not 50% of advisors in a decile in 1 year will be in that decile the next year?
Well, no, you're right, 10%. But I would instead, what I'm measuring, if we go back to that chart, I'm measuring what their average percentile rank is, right? So if we go to here, so well, let's just, so let's look at these blue vertical lines, vertical columns. So basically, if you go all the way to the left-hand column, the best 10% in year one, what was their average percentile rank? It would have been, you know, extended from 90 to 100. Their average percentile rank for performance in year one was 95, right? So I think that if performance were a matter of pure skill, that would be their average rank in year two. In the same way, in the second decile, it would be an average percentile rank of 85, between 80 and 90, and that's what it would be in year two, and all the way down to the bottom decile. So yes, there's only a 10% chance of being in that particular decile, but if they are going to be better than the people who performed poorly in 1 year, if they're going to continue to be better in the second year, you expect their percentile ranking to be duplicated from year one to year two. Does that make sense? Anyway, I'm going to get back to where was I? Okay, so we talked a little bit about this lesson earlier, that patience and discipline are virtues. I want to go through some of the reasons why. The next, and then it's a related topic, is does risk decline as investment horizon expands? So this is an important lesson because, and we mentioned this earlier too, is we expect that if we hold on long enough, the stock market will outperform the bond market. We saw earlier with that chart from Fama and French that if there is a decline in the possibility of underperforming the market, it doesn't decline as quickly as we want. And it may be, and that's what I'm going to talk about now, that risk in general does not decline as investment horizon expands. And this would be very, you should call into question the assumption behind almost all financial plans, right? That we expect that, you know, that yes, the sea can be stormy during a particular storm, but after the storm has passed, things will calm down again. I mean, basically, that's sort of the assumption behind most financial plans. But what if that is not true? So first, I want to provide the evidence supporting this notion. And it comes, I think, most famously from Jeremy Siegel's classic book, Stocks for the Long Run. So what he showed was the standard deviation of yearly returns based on holding periods since 1802. So if you look at a 1 year holding period, oh, actually, this is not standard deviation. I take it back. So basically, this is the odds that you're going to outperform bonds in any given year. So if you look at just all years since 1802, stocks have outperformed bonds about 61, 62% of the time. So if you just were to say, okay, what are my odds between now and a year from now of outperforming bonds, and the future was like the past, then your best bet is that you have about a 62% odds of outperforming. So as your holding period grows, this is what Siegel showed, is that the odds of outperforming bonds grow as well. So by 10 years, for example, it's up to 80%. Now, depending on whether you think the glass is half full or half empty, you can either say that's good news or bad news. It means that if you're going to buy stocks now for the next decade and the future is like the past, you can either say there's a 4 out of 5 chance you're going to be better off than bonds over the next decade, or if you're the glass half empty person, you'd say there's still a 1 out of 5 chance you're not going to be as well off as bonds. I tend to be in the latter category, but that's just who I am personality-wise. Interestingly, if you go to 20 years, it's now up just above 90%. Oops, and at the 30-year horizon, it's up at about 95%. So this is the classic chart that's shown by almost all financial planners in one way or another to their clients, which say if you're willing to hold on for long enough, things will work out. It turns out that, and the reason I want to go through this is that there's an alternate history that has now been circulating in academic circles. A guy at Santa Clara University, Edward Macquarie, he went through an exhaustive process of reconstructing the history of the US stock and bond markets back to 1793. And his data tell a profoundly different story than Siegel's. And I want to go through it because I think it's very important. So, and he emphasized he's not trying to criticize Siegel. Siegel relied on other sources, and those other sources had errors in them. So it's not Siegel's error, it's just that he was relying on other sources that had major omissions. For example, before 1871, the sources estimated dividends on stocks. There was no direct observation of dividends. Macquarie was able to actually go through copies of newspapers and other records to actually record the actual dividend payments. Secondly, Siegel's sources for stock returns prior to 1871 were based on equal weighted or price weighted indices. They weren't cap weighted. And yet Siegel's returns are chained together with the S&P 500 or the equivalent since 1871, which are cap weighted. So that's a major difference. Furthermore, Siegel was not able to observe bond prices prior to 1926. Instead, he applied a formula to transform successive annual yields, often from a single bond, and then imputed from that what the capital appreciation for the bond market must have been. And that's a straightforward calculation, but it leaves a lot of room for error. So basically, if you see the interest rates went from 5% to 4% in a year, you calculate, well, how much did the bond market go up that year? Well, actually, that formula requires any of a number of assumptions about the slope of the yield curve and so forth. So there's a lot of assumptions in that calculation. Macquarie was able to actually look at the original records for a lot of the bond market prices. Siegel furthermore approximated the risk-free bond by always selecting the lowest yielding federal or municipal bond available, even when that yield was depressed by tax exemptions and other privileges. Again, that's a major issue. Furthermore, some federal and municipal bonds between 1862 and 1879 paid interest in gold coin. Calculating that is rather tricky, as you can imagine. Furthermore, Siegel's sources omitted the largest single stock that traded before the panic of 1837. It was the second bank in the United States. And at the peak before that panic, believe it or not, that bank stock accounted for almost 30% of the total market cap of the US stock market. And Siegel did not include it. So by not including it, that alone, according to Macquarie, is probably the biggest single omission in Siegel's record of the stock market prior to 1871. And of course, that bank failed spectacularly in that panic, and shares went from 120 to $1.50 and never recovered. So here is Macquarie's results, and he looks at, it's basically very similar to the one that we saw from Siegel, but Now he reports entirely different results. Now let's look at this very first line. So the entire period from 1793, he shows the odds of stocks outperforming bonds is in any given year are 56%. Notice it was 62% in Siegel, slightly less, but not huge. But notice that it doesn't grow much beyond that. At 10 years, it's at 65%, and at 50 years, it's only 68%. So basically, he's saying no matter how long you hold stocks, even on the assumption that the future is going to be as good as the last 200 years, there's still only a 2 out of 3 chance you're going to outperform the bond market. But what's particularly interesting is when he broke the period down into 3 subperiods. So up till 1862, you actually had a declining probability of outperforming the bond market the longer you held stocks. So in fact, at 30 years, there was no 30-year period over that first third, basically, of US market history. There was no 30-year period in which stocks outperformed bonds, and no 50-year period either. Then we look at the period from 1863, in the middle of the Civil War, up to basically in the middle of World War II. Basically, there's no pattern whatsoever. At the 50-year horizon, the odds of outperforming bonds are basically no different than at a 1-year horizon. Again, profoundly different than the lesson that we articulate as financial planners to our clients all the time. And it's only in this last period, beginning in World War II, that you see the strong support for this notion that if you hold on long enough, you'll outperform the market, or outperform the bond market. So this is back to this general theme of extrapolating the past into the future. What Macquarie's data raised for us is the possibility that history is a succession of distinct regimes. It's not just one statistical history that we're trying to average. If there are regimes, we go from one regime to another, then looking at more history doesn't improve our forecast accuracy. That's because there's no one historical relationship between stocks and bonds that averaging more and more data gets us closer to estimating. The assumption behind a lot of our, a lot of what we do in the markets as historians is we think if we look at more data, we're going to get a more accurate forecast. The same way that if we, like you're a pollster in a presidential election, that if you sample more and more likely voters, we're going to get a more accurate result of our poll. But that's not going to be the case if history doesn't have one underlying relationship between stocks and bonds. Macquarie has a great quote, which I like, is that mashing apples and oranges together cannot give us a better grasp of how different fruits taste. And that's what really happened. If indeed the US market history is a collection of apples and oranges, we look at more and more history. Basically, what we end up doing is that we're trying to get a better grasp of how apples and oranges taste, but in fact, we get a mishmash that doesn't taste like either one. So what would the regimes of the equity premium be in US market history? And to this, I turn to a fellow named Brian Taylor. He's the chief economist at Global Financial Data, also a source of great US market history, in fact, world history, market history. So he thinks that he divides the US market history into slightly different periods of time than does Macquarie, but largely consistent. So up until 1914, there was interest rates stayed remarkably low. There was no overall trend in interest rates. They were low interest rates. And over that period of time, notice that the equity premium was basically non-existent, which I think is very depressing. So if we tell our clients that basically, if you hold on long enough, stocks are going to beat bonds. Well, here was a 122-year period in which there was no equity premium. So then we have the period from World War I through World War II. And it turns out there we had a modest equity premium of 2 percentage points. Then we have the period from 45 to 81 of dramatically rising interest rates, where the interest rate on the 10-year went from about 1% to clearly something over 15%. I don't know the exact number. So bonds were decimated, and stocks, of course, outperformed by a lot. So you had an equity premium of nearly 9 percentage points over that period from 45 to 81. But since 82, with declining interest rates, bonds have done better. And we have a relatively modest equity premium since 82. So if you look at history this way, it's a little bit hard to say stocks will always outperform bonds. It depends on what we think the future will be like. Brian Taylor, when I interviewed him, he doesn't think that any one of these past periods is the one that will apply to the future. If there was one that was closest, it might be that initial one from 1792 to 1914. He thinks that interest rates are going to be kept low by the Federal Reserve for the foreseeable future, in which case we should perhaps expect a relatively low equity premium. But what's interesting is almost all of the US market history where we, if we look at the Ibbotson data that's now part of Morningstar and which we all quote, goes back to 1926, is heavily dominated by that 45 to 81 period. And so we say, oh, well, history teaches us that stocks outperform bonds, but it's really a function of that 1945 to 1981 period. Next lesson is that risk is far greater than we assume. And so, and this really relates to this notion of equity premium. The point is that risk doesn't always pay off. So given the predominant role that luck plays in investment performance, I think the conclusion is that we should keep risk as low as possible. High risk inevitably leads to losses so big that recovery becomes unlikely. So the next slide I want to show you plots newsletters returns over the last 20 years against their risk levels. Notice that once risk exceeds that of the overall market, there's a diminishing return to more risk. So the red vertical line shows what the market's risk level. The horizontal axis at the bottom shows the volatility of monthly returns. And I normalized it so that the stock market's, the S&P 500s was set equal to just about 1 exactly. So then the vertical axis is the 20-year annualized return. And each of the blue dots represents another of the newsletters that we track. And I drew in just a simple linear regression trend line of what is the best fit for that. And notice that it's a downwardly trending trend line. So basically, if you were to look at the last 20 years and say, what conclusion should you draw about the relationship between risk and reward, you'd say, well, actually more risk actually reduces your reward. Now, there's a number of theoretical comebacks to this. Most of the theory about how you have higher return for higher risk refers to the efficient frontier, which would be these dots that are at the highest at each level. But even there, notice that up to about 1.3 relative risk, which is the one that I'm circling here. I don't know whether you can see my mouse, but basically that highest dot, which is about the 1.3 relative risk on that horizontal axis, there's no higher return among any of the newsletters. So the efficient frontier is downwardly trending, at least from that point. So what I say is that by all means, you shouldn't be significantly more risky than the market as a whole. It just doesn't pay off. So lesson number 5 is keep risk low. One of the last lessons I want to draw is that we have to appreciate there's a limit of statistics. And this, I think, is people find it interesting that I'll focus on this since I've spent my entire career focused on the statistics of investment newsletters and of investment performance generally. So you'd think that I would want to extol the virtues of statistics. And of course, the statistics are very important. But it turns out there's a huge limit to statistics, and that is that there's a statistically superior strategy is of little value to you if you'd be unwilling to follow it through thick and thin. This psychological dimension to investment success is too often overlooked, and it points to a different approach to judging advisors' performance. So, for example, we can start with the question, how many of us actually are true buy and hold investors? And I think that's an important question because we often compare our portfolio's return to the performance of the S&P 500. But that assumes that we're going to hold the S&P 500 through thick and thin. How many of us can we say, and for how many of us can we say that's true? I think it's the very rare investor who remains 100% invested in equities through a bear market. I have this great quote here from a former fixed income and commodities manager at TCW Group. He said to me once, the people who can truly stomach the volatility of a 100% stock portfolio are either catatonic or dead. And I think it's a great line, maybe exaggerated a little bit, but it makes the point. So most people who say they're buy and hold investors, they genuflect at the altar of buy and hold at the top of a bull market, let's say right now. So everyone says, oh, I'm a buy and hold investor. I can say with confidence that almost all of them will not be buy and hold investors at the bottom of the next bear market. In fact, at the bottom of the next bear market, what people will be extolling the virtues of is market timing. They say, well, we have to be a market timer and so forth. And notice that's just the opposite of what they should. We should be, if we're going to be market timers at any time, being a market timer at a market top is at least improves our chances of success relative to buying and holding. And if there's ever a time to be a buy and hold investor, it's at the bottom of a bear market. But that's just the opposite of what we do. So Ben Graham had a great line, which I think has a lot of wisdom in it. Ben Graham, of course, the father of fundamental investing, the author of the classic book in the 30s called The Intelligent Investor. He said, the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. So this really suggests a different standard, that maybe there's an alternative against which advisors ought to be compared. And that alternative may be doing nothing. Because if people are scared of the markets such that they don't want to do anything, they're probably not going to do well by any standard. So if an advisor is able to get that scared investor into doing something that he or she might not have been willing to do by him or herself, then he has improved that investor's future standard of living, improved that investor's retirement standard of living, and should be judged as success. Might the market for investment advice be as efficient as the stock market? I just raised that as a question. It turns out that, the way to look at, one way, which I've been guilty of over the years, is to say that most investment advisors aren't worth the paper their advice is printed on. But what if we should be looking at it differently? What if they are convincing people to do something that is probably in their best interest, but they were scared of doing? Maybe the market for investment advice isn't as inefficient as we think it is. I just raised that as a rhetorical question. So anyway, that leads me to lesson 6, which is that judging an advisor is more complicated than a matter of statistics alone. And so this leads me into the corollary that leads me into my next session, which I'll just leave you with, and then we can have some time for questions. If, I say, luck plays a predominant role and our emotions overreact by leading us to buy when we should sell and sell when we should buy, and believe it or not, both of those things are profoundly true, as we've seen. If both of those are true, then on average, advisors will be wrong. I think those two initial assumptions, which are true, follow logically then to that conclusion. And this is exactly what contrarian analysis believes. And this is why my focus on contrarian analysis follows from all these lessons about investment performance. On average, advisors will be wrong. And it's not just advisors, and on average, investors will be wrong. We all will be wrong on average. So that leads me into the slide at the beginning, the title slide for my second presentation. But let me stop there. I think we have about 15 minutes before this session ends, and let's see if there's any questions in the queue.
Yes, everyone, feel free to type in your question in the chat window. We'll monitor it and ask that for you.
There was one question, and it is, this time is different, in parentheses, is sometimes true. You want to comment on that?
Well, this is one of those philosophical questions that everyone debates. And, is it possible that this time is different? Well, of course, in some degree, every situation is different. Mark Twain said this: the future rhymes with the past, but it's not an exact repeat. So we can always find occasions where things are new, and we can also find occasions where things are not new, and that this time is not different. I think the problem with that philosophical discussion is that people use it for the wrong purposes. People who want to claim that the future is not like the past, in other words, that this time is different, tend to use it as justification for breaking their investment discipline. So let me give an example. There are plenty of advisors I track, as well as many investors I know, who were following the price earnings ratio, the price to book ratio, any of a number of valuation ratios, including the Buffett ratio or the Shiller ratio, the cyclically adjusted price earnings ratio. And coming out of the financial crisis, all those ratios suggested the market was either fairly valued or even somewhat undervalued. And so that was a good justification, and it turns out to be right. But as the market has gone higher and higher over the last decade, it became harder and harder to justify the market's valuation in terms of those ratios. So then there's an enormous pressure on advisors to come up with rationales for why they should stay invested, while nevertheless offering some sort of loyalty or some faith that they weren't completely just making up the rationales earlier for why they should be following those ratios. And it turns out those arguments become increasingly strained. So it's possible that the cyclically adjusted price earnings ratio doesn't apply anymore. It's possible the Buffett ratio doesn't apply anymore. But we should be asking those questions just as much at the bottom of a bear market as we are at the top of a bull market. And yet I find that people are not asking those questions at equal points of the market cycle. They do so at the top of the bull market. And usually, there's no way of quantifying this, but I find that people are most likely to give up on their investment discipline at the very time when they probably ought to pay it most attention. So I don't know whether that helps us any. I mean, we all know that there are ways in which the future will be unlike the past, and there are other ways in which it'll repeat. I think the way to look at it is that the market is probably more predictable over the long term than it is over the short term. So we don't know whether the market will be up or down on Monday. As we know, it's close to a 50-50 coin flip. But chances are that over the next number of decades, the market will be higher. But again, no guarantee. It's a higher probability than it is for whether the market will be up or down on Monday. There are regularities in the market, and we can count on them to some extent. But I'm having a hard time trying to generalize that into any sort of nugget of wisdom. I guess it really leads to the virtues of patience and discipline. But I think we should second guess our investment strategies at our peril, and afraid most people do so at the wrong times.
There's a question about clarifying lesson number 1. I think the slides did not specifically state lesson number 1, but I believe it had something to do with luck.
That's right. Well, I wonder if that screen didn't show up, so I won't try to scroll all the way back through, but it had to do with the role of luck. And so for example, that initial chart that I showed that where you'd expect newsletters that were in the top percentile, top decile for year number 1, where they'd be in top decile for year number 2, and so forth. The actual results are far closer to luck than they are to skill being the predominant factor. There are a number of ways, as you can imagine, in which statisticians over the years have tried to measure the relative role of luck and skill. There's one that I'll just mention in passing. You can look it up on SSRN, the Social Science Research Network, to do the more academic citations of it. But Brad Cornell is a professor of economics at UCLA. He has a relatively simple way of measuring it, and he applied it to large cap mutual funds in the Morningstar database and concluded that 93.2% of performance is due to luck. And that means only about 6.8% is due to skill. I applied the same methodology that he came up with to the investment newsletter industry, and I think I was within 1/10 of a percentage point similar result of the role that luck plays. Another way of measuring this is there's a way in which you can measure the speed with which performance regresses to the mean. And the impulse behind that measurement is this, that if indeed performance were a matter of luck, there'd be no regression to the mean. The advisor who performs well in year 1 would be the top performer in year 2 and year 3 and so forth. And the paradigm of that would be like a chess player. If I'm playing Big Blue or IBM's Watson computer in a game of chess, that computer is going to win every time. There'll be no regression to the mean. It obviously knows how to play chess better than I do. Whereas coin flip would be the paradigm of the opposite end of the extreme, where regression to the mean is immediate. If I flip a coin in the first flip, and then I'm going to flip number 2, what's my expected odds of coming up with a heads in the second flip? Is exactly 50%. The regression is immediate. So there's a way in which you can measure how quickly performance regresses to the mean, and it regresses almost as quickly as a coin flip. Not totally, but almost as quickly. And so lesson number 1 is just for us to remember just how much luck plays the predominant role. And as I think I mentioned earlier, I think most of us know this, but we act as though it doesn't apply to us. It's one of those things like you ask people, if you think you're an above average driver, and something like 86% of us say we're all above average drivers, and we can't all be above average drivers. We can't all be the children of Lake Wobegon. We're all above average. And yet that's how we go about our investment lives. We think that randomness and the luck apply to everyone else, but not to us. And so maybe another way of putting my lesson number 1 is to, not forget that it applies to you too. And, humbling as that is, luck plays a huge role. I mentioned just in passing, I'm sorry, there's a long-winded answer, but Benjamin Graham admitted this at the end of his life. It was one of the most remarkable admissions, is that it turns out that but for his investment in Geico, he would not have beaten the market over his investment career. And his investment in Geico almost completely failed. And he broke his own rules in investing in Geico. There was a point in the early 70s, you may recall, where Geico almost went bankrupt. They had to restate some earnings. There were some accounting difficulties. And what Ben Graham did is he bought a huge amount more of Geico when he should not have done that. That broke every one of his rules of the intelligent investor. And it turned out it worked out. But for that working out, he would not have beaten the market. So if you look at the postscript to, I think it's the 3rd edition of Investment, The Intelligent Investor, his famous book, he actually admits this. And he says, sometimes it's better to be lucky than to be wise, which I think is one of the most remarkable admissions of a guy whose entire life is devoted to rational investment analysis. And then in the end, he says it's better to be lucky than to be wise. And he then actually says, can you even tell the difference? And, I'd say that's a pretty humbling realization that even somebody as famous and as a greater performer, somebody that Warren Buffett extols as his mentor and so forth, in the end, because of one lucky bet, ended up beating the market.
Will you be covering any newsletters that have the best long-term record today?
No, I'm not going to be talking about individual newsletters. I do invite you to go to my website where you can look at all of the scoreboards that I have free of charge. There's no subscription, no paywall to get into it. And it's at hulbertratings.com, and there's a link for performance scoreboards, and you can go there. But I wanted to focus on some of these broader themes rather than individual newsletters in today's talk.
All right, thank you. Any comment as to how this relates to dual momentum theory as presented by Gary Antonucci?
Well, dual momentum has a lot to speak for it, so I don't want to comment on it. You remember earlier in response to an earlier question, I said that when presented with a strategy that looks to be overwhelming and has so much research, on its behalf, I'm always going to bet that it's not going to outperform the market. And I know I'll be wrong a small percentage of the time, but I'll be right a good percentage of the time. The same thing applies to dual momentum. And it has a fabulous track record, but if you look back historically, there are times when momentum strategies fail spectacularly. And so I'm thinking that perhaps one of the ways in which to understand the dual momentum is that it does well most of the time, but that is compensation for the risk of those spectacular times when it fails. And in the academic world, it's referred to as momentum crashes, where just where the worst performing stocks just automatically are, not automatically, they are overwhelmingly outperforming the top performers. It doesn't happen often, but it's just the opposite of momentum. And it's so bad, the performance in those months, that some researchers are calling it momentum crashes. So in the same way, there are a lot of option strategies. You can write puts, out of the money puts, a couple weeks before expiration, and you'll make money 99 times out of 100, and it looks great. But one time out of 100, there'll be a market crash, and you're going to find yourself bankrupt. And that's exactly what happened in the 1987 crash, for example. And so there are a lot of these strategies that you look at over a long period of time that you think is sufficiently long to persuade you that it works. But really, its outperformance is compensation for the risk of those one rare time when you will lose big. And I think this may apply to momentum and dual momentum in particular. But I want to stress, I've not studied dual momentum in particular. I think some of the newsletters that we track focus on at least variants of that strategy. But it's just more of a general a priori response to every analysis that comes up, every strategy is I'm going to bet that it's not going to beat the market.
And last question before we go to break. Advisors always tell us that when they underperform, that this is strategic. Do you believe that a sequence of periods of underperformance by managers can result in, ultimately later, longer term success?
Oh, yeah, I wish it were that easy. I think, is it possible that somebody has done that strategically? Of course, it's possible. But I'd say overwhelmingly, advisors who try to justify underperforming the market by saying, "Oh, I meant to do it," is an after-the-fact justification in hopes of not losing assets under management. So I'm very cynical about that argument. But I admit that it's possible that somebody did it on purpose. The question really is, are those newsletters that underperform over a certain period of time, do they outperform over the long term such that they're better off for having underperformed? I've seen no evidence of that among the newsletters that we track.
All right. Well, thank you so much, Mark. This concludes session 1. We will come back for session 2 at 10:30. So give everybody a chance for a bio break and then be back at 10:30.